Mel Mattison, thank you for being here today.
Thank you for having me. I appreciate it.
So, Mel is, for the listeners, an entrepreneur, certified financial planner, investor, and the author of a new book this year called Quoz. And I just want to let people know that are listening, I'm going to send a copy of Quoz to the first 5 listeners who claim it. So, wherever you're listening, subscribe to Who Knows and just fill out the form you'll see in the description below for a chance, and I'll send it out to you. So Mel, what has your career been like that's brought you to write this book?
Sure. So I have worked at least the last 20 years. I think, depending on how you want to calculate things, you could go back a little further, but in what I would call traditional finance, financial services, very large registered investment advisors, very large asset managers, such as Russell Investments out in Seattle. It's not huge. It's not a BlackRock, but still manages about $250 billion. So we're not talking about small sums here. I've served as the CEO of 3 different FINRA, SEC registered broker dealers. During the course of these past decades, I've studied and gotten an MBA in investment corporate finance from Duke University, Fuqua School of Business. And I've really, just been embedded working, and then at the same time doing my own thing on the side as an investor, involved in crypto, involved in stocks, bonds, real estate, different things, and built up essentially over this same period of time what I believe is a pretty good grasp of financial history. It's something that has always been a area of interest to me. I've read dozens, scores of books, just trying to increase my knowledge of what's actually going on, what has gone on, whether that's a history of central banking, what happened during the Depression. For example, right now I'm in the midst of a very detailed biography of a gentleman who's fascinating, by the way, named Albert Gallatin. He was the 4th Secretary of the Treasury of the United States under Jefferson, and as well as Madison for a while. He served 12 years. And, Jefferson talked about how Gallatin is the only man that can unravel the financial labyrinth that Alexander Hamilton had gotten the U.S. into in the beginning. And so just looking at monetary history, U.S. history, studying all of the history, the Bank of North America, which was our revolutionary central bank, first Bank of the United States, our first central bank, second Bank of the United States, our second central bank, which was essentially shut down by Andrew Jackson, how the Federal Reserve got started, all of these things. So basically what I bring to the table, I hope, is a combination of real world experience, working for various firms, as well as kind of a philosophical academic understanding of finance and financial history. And these things have just led me to, I think, viewpoints that your listeners would not be unfamiliar with, but that expose the essential rot at the core of the monetary and financial system that we live in, and how it got that way. And that's what I like to focus on and talk about, and what I believe I kind of bring a little bit of information to the table for.
So then, give us a little teaser on the book itself.
Mm-hmm. Sure. So Quoz, a financial thriller, along with those other things. I've always been a fan of thriller novels, traditional guys like, your Tom Clancy, or maybe more recent people like Jack Carr or something. And what I wanted to do was take some of these financial, economic, monetary insights and try to combine that into actual fictional books. So to tell a story that's a good read, but that also has a little bit of insight into our current situation. And so Quoz is really, I think the headline I used is "The annihilation of the global economic order is just the beginning. Quantum AI, corrupt central bankers, and the blockchain combine in a stock market supernova." So really what it is it's about this corrupt cabal of central bankers, ostensibly headquartered around the BIS, which is the Bank for International Settlements, a real organization based in Basel, Switzerland, and their attempts at kind of subversion of the current monetary system and replacement with a global CBDC.
Mm-hmm.
And so that's Quoz is kind of an abbreviation for Quantum Oz, which is a location in the novel, this kind of subfloor at the BIS where this massive quantum computer is located. But I'd also add one little side note. It's a little bit of homage to Oz, to the Wizard of Oz, which some people may be familiar with. It really, at its heart, was a monetary allegory, The Wonderful Wizard of Oz, as it was written by L. Frank Baum. He was the author. The movie, they switched up the silver shoes in the book to ruby slippers to take advantage of the colorization. But what Baum was really saying in The Wizard of Oz was it was the scarecrow was the agrarian people. The Tin Man was the factory worker.
Mm.
You know, the lion was the soldier, the military class. And you had the yellow brick road and you had these silver shoes and you had these monetary standards.
Wow.
And there was this false hope in the Emerald City, you know, the greenbacks, the dollar, and the man behind the curtain. And this was a monetary allegory that Baum put together because of the huge monetary chaos that was happening at the time he wrote this.
Wow.
As the United States transferred from a bimetallic system with gold and silver as monetary metals to a gold standard. And so it's a little bit of an homage to Oz. I think a lot of people don't understand that connection, but it's there clear as day.
I had no idea that was about financial, like the financial system. That's crazy. What year was that book written?
And it was very early 1900, around 1901, something like that. Not long after Williams Jennings Bryan, I believe in the 1896 presidential convention, did his Cross of Gold speech, which is one of the most famous American political speeches. What was going on at the time, for people that might not be aware, is, you know, in the Western expansion of the United States, there was large deposits of silver. And silver was being mined and being used as a monetary metal. There was pressure that was put on the United States to take this increase in silver out of the picture because of basically bankers and central bankers in Europe, especially at the Bank of England, who were very fixated on a gold standard. And so you had a law passed, I think it was the Coinage and Coin Act of 1873, which was colloquially referred to as the Crime of 73, which essentially ended the 100-year history in the United States of accepting both gold and silver as monetary metals. A lot of people will remember that when the Constitution was written, there was a certain amount of gold that was equivalent to a certain amount of silver, and that this was the basis of the dollar. And that was ended. And the silver was essentially the people's metal. It was a metal that was used a lot in the West, and it was cut out of the monetary system because the people in Europe, who were the big power brokers at the time, didn't like this monetary metal. Similar to Bitcoin, you know, I don't know, but it wasn't a new metal, but it was this increase and this control more coming from Western United States, big silver deposits in Nevada. And it was immediately kind of X'd out of the financial system. And that was permanently put in place, obviously, by the time, you know, 1913 came around, the Federal Reserve. And silver has not been a part of the official monetary base of the United States since 1873. But in the 1890s, early 1900s, there had been a period, what they called the Long Depression. There had been a lot of financial turmoil in the United States, and people wanted to bring back silver. And so Baum was really catching onto that zeitgeist at the time of the turn of the century there, that was an avocation of silver. And that was why at the end of the book, it wasn't the yellow brick road and it wasn't the Emerald City that got Dorothy home. It was the clicking together of what in the book were the silver shoes.
Oh, wow. Why didn't the powers that be in Europe want silver introduced into the monetary system or used?
Mm-hmm. Sure. So I think it's the same reason they might not want Bitcoin, right? It's they don't have the control over it. They don't have the control over the supply. They also are not the big holders of it.
Oh.
And so it was this worry that as the United States silver deposits obviously people don't know, like, how big are these deposits? Like,
Yeah.
how much silver is going to be there?
Hmm.
And you had similar things, not to get too much all over the map, but you had very similar concerns happening, obviously, in the 1940s, as people recognized that coming out of World War II, the dollar was going to become dominant and replace the pound sterling.
Hmm.
And so you have these historical European banking clans, banking power, that have really affected a lot of what goes on in the United States. And they've seen threats from the United States at various points in history that they've tried to thwart, and to some extent have been successful thwarting them. And so I think really what was going on there was just silver has always been a little bit of a thorn in folks' shoes. Silver has a very long history. At different times, it's traded at all different valuations relative to gold. You can go back hundreds of years. In China, it used to trade 1-to-1 with gold. At the formation of the United States, it was 15-to-1. A few years later, they changed it to 16-to-1. Now it's, I think, something in the order of 60, 70, 80-to-1. I mean,
Wow.
so silver has consistently been devalued relative to gold for various reasons, but it still has more what, economists or finance guys would call beta. So it still has a little bit more volatility to it in beta,
Hmm.
but the long-term trend of silver relative to gold, I think in some sense, unfortunately, has been negative. But that just brings it back to what was going on with, they really wanted to push silver out of the monetary system.
Oh, wow. So I thought silver, um, silver basically has a higher inflation rate, doesn't it? Or like a worse stock to flow. Like it gets pulled out of the ground uh, more easily than gold does. So I thought if there weren't people trying to strangle markets, if it was a completely free market, that silver would debase against gold, just in that new supply comes online every year at a higher rate than gold.
Mm-hmm.
Is that true, or is that and if so, is that actually playing into it too, or do you think it's mostly controlled by humans?
Well, I think it's actually mostly human desire to focus on gold as
Hmm.
the monetary metal. I think
Okay.
silver, it is more abundant in it has more of these sporadic flows. I think one of the things that happened was really, there's a lot more silver deposits in the New World than what people expected. And so
Hmm.
before these Western deposits were found in the United States in the 1800s, there were these massive deposits found in Mexico and Peru.
Well,
And so this is a problem, like, right, that Bitcoin doesn't have. This is something
yeah.
that Bitcoin was attempting to alleviate. And it's what I would consider a little bit of an advantage as a monetary instrument over PMs, precious metals, is you do get these stock and flow. You get these discoveries that can come suddenly into the market and really affect, finances.
Hmm.
We had a large Mexican discovery in the beginning of the United States that really affected, silver prices relative to gold.
Wow.
And you had this situation where you had different monetary coins being produced, and silver prices being essentially inflated due to the fact that the Constitution stipulated a 15-to-1 ratio. And what
Mm.
happened was, post 1789, when the Constitution was passed, silver discoveries in Mexico made it such that the market rate of silver was really more 17-to-1 rather than 15-to-1. And so a famous, economic law is Gresham's law.
Mm.
It's known as, bad money chases out the good money.
Yep.
So what happened is the silver was legal tender at 15-to-1, but it really should have been 16-to-1. And so everybody started holding and hoarding gold coins in the New Republic of the United States. And so nobody would do transactions in gold.
Hmm.
They would just do it in silver because that was, essentially overvalued. And then there were all kinds of nitty gritty things that happened where US silver coins, the dollar silvers, had a little bit less silver than the Spanish dollar.
Oh, wow.
And so people stopped using Spanish dollars. They started using US dollars. But then when it came to the fractional amounts, like half dollars, quarter dollars, the US was actually had a little bit more silver in it than the Spanish. And so if you look at like what was happening in the United States around, say, 1790s, 1800, is all transactions were happening in fractional silver coins
Wow.
because people realized the different monetary content. And this is actually where the dollar comes from. The dollar was the name for it was a Spanish name. We're used to people calling the Spanish peso, but people called the Spanish silver coin a dollar. And that's why we have the United States dollar, because most people trusted the Spanish dollar as the premier monetary coin at the time due to their huge Latin American empire. And so 80% of transactions in the early United States took place in Spanish dollars. They did not use United States dollars because silver was silver. And the United States mints at that point in time offered free service. Anybody could bring in silver. They would melt it down, press it into a U.S. coin. So you could take Spanish dollars to a mint if you wanted U.S. coinage, for example. But nobody really cared about that because silver is silver, gold is gold. You give me a Spanish silver coin or a U.S. coin, it doesn't matter. But most commerce in the early United States history was conducted in Spanish silver dollars.
Wow, that is crazy. So I do want to ask you about central banking more specifically. So I think we're going to have to go backwards now in history to kind of build up the story of how we have the Federal Reserve and central banks around the world. So what was the first central bank, and when and how did that come about?
So there was an early central bank. The very first one was in Sweden, but really the godfather of central banks is the Bank of England, and that was the central bank that was set up in such a way that it became the model for other central banks. So when I look back at central bank history, I think it's good to start in the 1690s. So we're talking about a reign of a king, William III in England. And he set up the Bank of England, and I'll get into a little bit of why and how and what central banks really do. But this was the creation and the transformation of essentially a European Western economy that was very much based on land, aristocracy, these types of power levels that began that transition to money as a massive control mechanism for society, and also as a transfer of power away from what Jefferson called the three braids of society, which were social power, political power, and economic power. And initially, all these three were combined in the sovereign, in the king, really. A social power through his standing as the king, his divine right to be king, the economic power that he had, and the political power as the maker of laws. And we begin to pull apart those three braids. The U.S. Revolution really pulled apart the political braid. But before the U.S. Revolution, the economic braid was pulled apart from this three-legged stool, if you will, by the creation of the Bank of England in 1694. And what was happening there was William III had been a sovereign who had essentially maxed out his credit. He had borrowed a lot of money from wealthy people in England and actually defaulted. He couldn't pay it back, and therefore he could not get new loans from the wealthy. He had also overtaxed his people, and he recognized the fact that had he continued to increase taxes, the likelihood was that there would be revolts, civil unrest, and issues with the other aristocracy, the dukes and so on. And so he couldn't tax and he couldn't borrow, but he wanted money because he had an ongoing feud with France, as they were always fighting back then, and he wanted to continue this war with them, and he wanted to build ships and field an army. And the shipbuilders and the armies would not accept paper notes or loans. They wanted gold and or silver. Mm-hmm. And so he met with the wealthy banking members of the London elite and expressed this concern. And the London elite and the king essentially came up with this plan. They said, look, we don't want to give you our gold and silver because we don't know if you're good for it. But here's a mechanism we can take gold and silver from the people and funnel it to you so you can fund your war. And here's what we're going to do. You're going to give us a charter to set up a bank with the exclusive rights to essentially print paper money. And then you're going to make as law that this paper money must be accepted. It must be, like it says on our money, this is legal tender for all debts, public and private. So you're going to essentially sanction paper money. And what we're going to do is we're going to go to the people. We are going to take in their paper money, or excuse me, their gold and silver, and give to them notes. We're going to give them an ostensible interest rate. And then they will see the utility of paper notes instead of gold and silver. They'll believe their gold and silver is safe at this central bank. And they're not only is it going to be safe at the central bank, they're going to get a little interest. And then we're going to give you the gold and silver. And so really what it was obviously the central bank, never carried through on keeping it safe. There was fractional reserve lending that at any point in time, should the people go to the bank and demand all of their gold and silver that these paper notes represented, the bank would be insolvent. But the people, through coercion, propaganda, the enforcement of the paper notes as legal tender, were essentially conned into this. And so gold and silver went into the Bank of England. Paper notes were issued, gold and silver given to the king. And what happened really was the bankers, and this is essentially what's going on today, is they made all this money off of the people and the government. Mm-hmm. And that is what a central bank does, is it makes money off of the people and the government so that people deposit money. It goes into the banking system, into the commercial banks. You put your money at JP Morgan, which is a loan to JP Morgan. They pay you 0.08% or whatever their checking rate is now. Yeah. They then have two options. They can take that money that they've gotten from you, which you're getting less than 1% interest rate on. Mm-hmm. They can do two things with it. They can either deposit it with the Federal Reserve, which will pay interest on reserves at the government rates of 5%, so mm-hmm. they can get a risk-free 5%, or they can take your money, which they're paying you less than 1% on, and they can loan it out to risky ventures that, in some sort of diversified basket should return 8, 9, 10, 12%. Mm-hmm. And so what the banks do is what they've always done, is they take the money from the people, they give the people almost no return, and then they invest it either to the government or to risky ventures. And then, you add on top of it, which we've seen happen multiple times just in the last 20 years, is should those risky ventures not pay off, the government and the taxpayer will come in and bail it all out. Right. And this is the ultimate corruption of the financial system. And it's what stable coins, Bitcoin, what these pose as a threat is to take that away and to pull it out of there. And that's what's so dangerous. Mm.
Wow, it's fascinating. I was curious to know if that is, from your research, the history of or the formation of the Bank of England. How do you think the Bank of England writes its own history? What do they describe happened to form that? What was the purpose?
No, well, so it's only been in recent decades that these central banks have been nominally taken out of the control of private banks. So an example, when Hamilton formed in the United States, the first bank of the United States, Hamilton, so the United States during the Revolution, they printed a fiat currency called the Continental. The initial issue of the Continental was a $2 million issue. By 1779, I think it was, they were issuing over 150 million Continentals a year. So the amount of,
that's
at
like
the end of the day,
Venezuela level or Weimar Germany or something, isn't it?
That's what happened. So Continentals ultimately, which were the first United States currency during the Revolutionary period. Ultimately, Hamilton, as the first Treasury Secretary, redeemed Continentals. And if you took in Continentals to the Treasury, what you got paid back was a United States bond, a note, at 1 to 100. So for every 100 Continentals you took in, you got $1 of a U.S.
Wow.
loan. So that was the type of debasement that happened during the Revolution, and that was what Hamilton, when he came in as the Treasury Secretary, not only did he, so the currency, which a lot of people held, were 1 to 100, but what he also did was he took the federal debt, which had also ballooned to over 200 million in federal debt, and then he did what's known as assumption. And assumption was probably the biggest political issue of Washington's first term, which was the federal government assuming the debt liabilities of the colonies, now states. So Hamilton realized that the only way the states could pay off their debts were through taxation. And he realized taxation was the power base. And he wanted the federal government to keep that taxation power. And so what he did was he went to the states and said, we're going to take Virginia, Massachusetts, we're going to take your debt, we're going to assume it, the federal government, as a liability of the federal government, and we're going to pay it off. But because of that, we're also going to institute, taxes. And so Hamilton very quickly coalesced so there's really three people in the post-revolutionary period that built our modern system here in the United States. Hamilton, a guy by the name of Robert Morris, who was the wealthiest man in the colonies in 1775. He eventually wound up in bankruptcy prison. He was a crazy character. And this other guy, Albert Gallatin, who was Jefferson's secretary. I have a little bit of this on my mind because I've been reading this. It's kind of a 4th of July theme. Let me review revolutionary finances. But it's really fascinating. And what Hamilton did was, so he paid off 1 to 100, the currency, and then he took all this debt, which most people felt there's no way the United States is going to be able to repay this debt. And so patriotic Americans had bought a lot of this debt to fund the revolution. It was a patriotic thing, just like we had war bond drives. And as the revolution wore on, and eventually in the 1780s, we come out with the Constitution, different things, people still felt that this debt was not going to be repaid. And so they did not pay it. They sold it, and they sold it for like 10, 20 cents on the dollar. And it was almost bought entirely by less than like 300 people controlled almost all of this debt. And it was mostly people in New York and Philadelphia, many of whom were agents for wealthy Europeans. And so all of this U.S. debt is essentially consolidated at 10 to 20 cents on the dollar in the hands of these wealthy elites based in New York and Philadelphia, who in turn a lot of them were acting as proxies for European banking cartels. And Hamilton comes in and he's like, okay, actually, we're going to pay off this debt, but we can't pay it off now because we don't have the money. So he does a massive debt restructuring. So all of the United States revolutionary debt, state debt, it all gets restructured, and he does it in such a way that he borrows new money, pays off these old debts, and then he reduced the interest rate. So Revolutionary War debt was around 6% weighted average. He got it down to around a 4% interest rate, and he set up the prepayments to be like, we're just going to pay interest, which is the way it is now. You just pay interest. When Gallatin came in, he changed it. It was more like a mortgage. U.S. debt payments were not just interest, they were interest and principal, so that the U.S. would issue a 10-year bond. At the end of those 10 years, the 10-year bond would be paid off because the U.S. had to pay interest and principal like people now do on mortgages. If you look at, Treasury debt now, all the U.S. pays is interest. And Gallatin realized this is just going to cause a debt bubble. This is, as long as all we have to pay is interest and then we can refinance, all we're ever going to do is pay interest.
Yeah.
And that's more or less what happened. And so this whole situation that was put into play, I mean, it's ridiculous how similar the current situation is to post-revolutionary war. It was, debt crisis, currency crisis, immigration crisis. We had the Alien and Sedition Act. People were really worried about all of these French immigrants fleeing revolutionary France, their impact on the culture. Like everything we're seeing today is you could almost like just book print it onto the 1780s and 1790s.
Wow. So maybe take us through how many central banks has the U.S. had? Are we on our third or fourth?
Yeah, third or fourth is the way to think about it,
Okay.
because we put in something that was like a quasi central bank during the Revolution. It was called the Bank of North America. It was run by Robert Morris, this wealthy New Yorker. But then again, this was a big debate in Washington's term was, do we want to have a central bank? The Treasury was the federal government back then. So Hamilton consolidated all power. 90% of federal employees were in the Department of Treasury. So the Department of Treasury did not just run Treasury. It ran lighthouses. It ran the Postal Service.
Really?
It ran the IRS. It ran everything. And Hamilton, for people not very familiar with him, he was like a big federalist. He had this vision of America as a global superpower, economic power, and he saw the path to that, like embedding the United States economically with the economic power in Europe. And so he was really, I'm not casting dispersions on his patriotism or, I just think his vision of America was this vision as this kind of global economic superpower. And he saw the only way to carry that out was essentially getting into bed with the current economic powers, which were Europe. And so he was very cozy with them. The one thing I didn't mention was with those bonds, what he did was he said, okay, we're going to pay off your bonds, but also we're going to give bondholders the preferred right to buy shares in the first Bank of the United States, which was the first central bank of the United States. So you essentially had these New York speculators buying debt 10-20% on the dollar off the public, and then they were exchanged for shares in the central bank of the United States. And this was a chartered bank that was the only bank. It was part of the law that was passed by Congress to institute this. It was a 20-year charter, and it was the exclusive bank. And again, exclusivity is key. No other monetary competitors allowed. Only this bank can essentially issue legal tender. And that's what the first Bank of the United States did. When its charter ran up 20 years later, which was 1911, I don't think it's a coincidence that we found ourselves under attack by Great Britain the very next year in the start of the War of 1812. So when we tried to leave the central bank system and we essentially dissed these European powers, the European powers, came after us. War of 1812 is over. We ostensibly won, but we also agreed to charter a second central bank of the United States, which we did post War of 1812. And it was not until 1836 that was dissolved after a 20-year charter. Andrew Jackson paid off all of the debt. He hated central banks. Jefferson, central banks and monetary policy were huge issues. These were issues that were not on the back burner. They were like today because they were so important. And so, you have this really crazy history in the United States of central banks, of currency crisis, of bank crises, and different things. And there was this kind of interregnum period between 1836 and 1913 when the Federal Reserve came in place. But that should not be looked at as like necessarily a panacea golden time where we had no central bank, because really what we did at that period in time was we allowed a lot of states and we had a national charter system and a state charter system. And so the state essentially sanctioned multiple central banks. So we didn't have one central bank. We had a lot of banks that were given this power to print money. And that's why even people can say, well, weren't there panics? The panic of 1907, there were stock bubbles, but there was no central bank. So you can't argue that central banking is at the root cause. My argument is not that central banking is at the root cause. My argument is that fractional reserve banking, where you give institutions a chartered government policy to print money
Yeah.
and take in a small amount of money and print an exponential amount of money, that's where you get in trouble. And we did have that, even though we didn't have a central bank.
Oh,
And so
wow.
these banking systems are really what are driving a lot of these bubbles and things that happened when we didn't have a central bank.
So the going back to the beginning of the story, if the Bank of England was basically a fraud and a like hidden tax on the people, basically covert way to steal money from them, and the colonies were trying to split away from the burden of England and taxation, the exorbitant taxation on the colonies. How the heck did we end up with our own central banks? Was it just a necessity, like during these specific times? It sounds so antithetical to the point of like the revolution. You know what I
Yeah,
mean?
and there were insurrections and there were rebellions in these first 10, 20 years. People wanted to excuse me, revolt against this, and they were kept down at the point of a bayonet by United States troops.
Mm.
The army was called out. We had the Whiskey Rebellion in the 1790s. So what these were about were exactly about that. So the federal government quickly realized, okay, we have this debt. We need to orchestrate a federal government. We need money, and we need to tax. And there was no income tax potential in the Constitution. That did not occur until 1913, which is the exact same year the Federal Reserve came into existence.
Tough year. Tough year.
It was a tough year. It was a tough year, and surprisingly, what started the next year, right? The World War One. So I don't think these are coincidences that massive monetary kind of issues are being dealt with, put into place, and then you get these wars. But basically, what happened was they said, okay, so we've got a country, we need to fund it. We have limited taxation power. So the Constitution at that point in time allowed for direct taxes, but it needed to be apportioned by the states and it needed to be handled in certain ways. And so they came up with different land taxes, essentially like a property tax that the federal government was doing. But they realized that was very unpopular. And so then they said, okay, well, let's go with tariffs. So we can tax, the import of goods and get our money that way. That worked for a little bit, but where there was a fault with that was that it was a stronger burden on the southern states. So the southern states were more agrarian, and they tended to import a lot more goods, and there's a lot more manufacturing in the north. And so the southern states got a lot of their goods from overseas, from England. They had to pay tariff, and so it's very rational. Like, I'm not saying these people are bad people. I'm not saying Hamilton or Washington are bad people, but they're racking their brains. How do we draw money from the people to fund this federal government we've now got? And so very rationally, they thought to themselves, okay, here's a good idea. Let's tax items that people don't have to buy, and we will bring in money that way. And let's think about what are items that people don't need to buy. They came up with luxury leather goods, so like very high quality saddles, and they came up with whiskey. Now, whiskey tended to be very much in what was at that point in time the frontier areas, the mountains of Pennsylvania or West Virginia. And so you had the whiskey tax, and you had, in I think it was 1794, what became known as the Whiskey Rebellion. And this was a very large-scale insurrection against the federal government's attempts to collect this whiskey tax. And so what happens is all of these overt taxes keep they're problematic. And what a democracy realized was, how do we tax the people where essentially the people don't know they're being taxed?
Yeah.
And that solution was inflation. And so debasement of currency was essentially the solution to how do you tax the people without putting taxes directly upon the people.
Oh man, that's crazy. Um, I wanted to ask you about Jefferson. You mentioned him. Where did he stand on the idea of a central bank?
Yeah, he was adamantly opposed to it. He was unfortunately, when he was in office, there was no decision to be made. So it was, I believe, 1791 to 1811 was the 20-year charter that the first central bank got. Jefferson was elected in 1800 and served to 1808.
Mm.
And so we had a president in office who would have been adamantly against a central bank, but there was no decision to be made. That 1800 election, by the way, again, I talk about imprinting things on. I mean, talk about a highly contested election. It was an electoral vote tie. It went to the House of Representatives. It took 36 ballots in the House. You had different slates of electors sent by the different states to the House. You had a bill in Congress that was
Wow.
going to allow Congress to decide which electors to accept or not accept. You have so many similar things going on back then, and like I said, a lot of people, if they are like, oh man, what's going on with our country? We've got problems with our currency, we've got problems with debt, we've got electoral uncertainty. Like, hey, welcome to the United States. If you look at the history, this is the history of democracy. And it goes back all the way to our founding, where you have these bankers, and you had really two wings of um, the Republican Party. So this isn't the same Republican Party that we call it today. In the 1700s, the two main parties were the Federalists. This is Hamilton. This is John Adams, was the first Federalist president, the second president of the United States. And you had what they called themselves at the time, the Republicans, Jefferson with Gallatin as his Treasury Secretary. So Jefferson was adamantly against a central bank. He looked at what Hamilton had gotten us involved in, and he did not understand it, but he had an instinctual feel that there's something wrong with this. And one of his quotes was, Gallatin is the only man that can unravel the United States finances from this labyrinth that Hamilton has gotten us into. So he brings in Gallatin, and Gallatin, during his term as Treasury Secretary, he makes these sweeping changes where United States debt is not just going to pay interest; we're going to pay interest and principal. He advocates for the reduction in military spending. He advocates for some sort of increase in taxes in order to pay off the debt. He says if we're going to spend money on debt, it needs to be for things that are going to benefit the American people in the long term. And so most of the debt that you see under Gallatin was for roads, canals, as well as probably the greatest investment of all time, which is the Louisiana Purchase in 1803, where we bought essentially half of the Western United States for like 2 cents an acre from France. And so that was where our debt went to. It didn't go to stimulus checks and, defense contractors. It went to buy the Louisiana Purchase. It went to build roads and canals. And by the way, not only did he manage to finance all of those long-term great investments, he also managed to reduce the national debt by more than half during his 12 years in office.
Wow.
So that's what Gallatin achieved, and then it started to go a little bit off the rails again after him.
Wow, that's wild. Okay, I wanted to ask you about the Federal Reserve, which is our current central bank. Do you think we missed anything in the story leading up to that? Before we talk about the formation of the Federal Reserve, what it does, anything important you think we missed?
Going from that period of time, from like Revolution until then, I think what you have is this continual back and forth, and these are the moneyed interests, the people who benefit from increased trade or these types of situations also fighting against the well-being of the people. And there are periods in time. So, for example, when Hamilton was Secretary of the Treasury, where one side's kind of winning, and then Gallatin comes in, and then it changes. And you continually have this back and forth. And all I would say, without getting into details of what happened in the 1800s, is that you had this same type of back and forth where you have this increase in power control of the moneyed interests, and then you have the decrease in the power and control of the people. And what I would maybe add as far as a key point to bring up about the 1800s is that you had this growth of between about the 1820s and 1860s of these moneyed interests. And this was, a lot of this had to do with railroads, but essentially you got more and more consolidated wealth in the 1820s to 1860s. And the way I look at it from a financial perspective is real wages as a percentage of GDP. And if you look at real wages as a percentage of GDP between 1820 and 1860, they're cut in half. In other words, GDP was growing, but the amount that Americans were making from working was getting less and less relative to economic production. And what you see almost perfectly between 1970 and today is the exact same thing.
Yep.
Real wages as a percentage of GDP have been cut in half between 1970 and today. And what happens, and there's a guy, Peter Titchen, I believe is his name. Have you ever heard of him as an author?
No.
He's a famous author. You know, I'm more of a capitalist type guy, leaning that way. He's actually more of a left wing guy, but super intelligent guy. And I like to read the whole spectrum of what's out there by intelligent people. And he has a book that really, I forget the name of it right now, but his name's Peter Titchen. He really looks at, you know, societies over time and how they evolve. And he goes back to France and everything in the United States. And he sees these long cycles. And what tend to happen during these cycles is that the wealthy get wealthier, the poor get poorer. And what happens is, as the wealth class kind of gets wealthier and expands a little bit in their numbers, they have fewer and fewer seats of power to occupy. So let me see if I can rephrase it. So he's got the people, and then he has what he calls the elites. And as wealth grows, you get more and more elites that want these power positions, but the power positions are not expanding. So it's like a reverse game of musical chairs, where you have the music going, but instead of every time it stops, you take away a chair. It's that every time it stops, more elites get into the circle trying to get into these chairs. And there's a certain phase in the beginning of cycles where the number of elites is roughly a good match for the number of kind of power positions, and the elites don't fight too much amongst themselves. But as the elites grow, they start to overpopulate, and there's not enough power positions, and you get the rise of counter elites. And so what I would say is happening right now is we have had a large rise in counter elites, where you could have a Clinton arm of the Democratic Party, and then you have a Bernie Sanders arm. You have a Mitt Romney, George Bush arm of the Republican Party, and then you have a Donald Trump arm. And he would look at it and say, Donald Trump and Bernie Sanders are not elites, they're counter elites. Okay. And this is a symptom of kind of an overpopulation of elites. And this is what eventually drives civil unrest and revolutions, is this overpopulation of elites. The elites begin to fight amongst themselves. And you see it, you know, just this week in France, where, you know, you have the kind of centrist party kind of in the middle there, and you have people voting for the far left party. You have people voting for the National Rally Le Pen party. And the reason these counter elites start to do well is because the people are getting more and more screwed over. This is the reduction in real wages. And so the people in our society right now, this is a multi-decade trend that is kind of culminating, coming to a crescendo, is they've been getting screwed over in this country, I would say, you know, since the 50s. since we took up the reserve currency status, which I believe was the worst thing that ever happened in the United States. And essentially, we hollowed out our manufacturing. We could get into that. It's a whole other thing.
Yeah.
But we're basically getting to a point where the people are getting so dissatisfied that they're starting to get almost a revolutionary tone to them, and on the left and the right. And I think that was going on in the United States in the 1800s. It culminated in the election of 1860, where you had a 3-candidate race. Lincoln, most Americans thought Lincoln was a crazy extremist. But he was put into office with like 30% of the vote because it was a 3-way race, and that took us down that road. So I think it's important to understand that as we then move into the 1900s and you get into this other period around 1913 with the Federal Reserve, where this same sort of process is starting again and again, and then culminates in the 1929 stock market crash.
Wow. So it looks like that book by Peter Turchin is called End Times. So all elites, counter elites, and the path of political disintegration. So I'll link to that if anyone wants to read it. So yeah, let's go to the forming of the Federal Reserve in 1913. How did that come about? What was the purpose? What were they supposed to be doing? How did it get through?
So this was a long, plan that I think it came out in 1873 with what was known as the Crime of 73, where we went up the silver standard. There was this desire to move to a pure gold standard and then to consolidate things with the central bank. And in the 1890s, J.P. Morgan began funding a movement to create a central bank. So a lot of people are very familiar with the Creature from Jekyll Island by G. Edward Griffin, the seminal book on the formation of the Federal Reserve, where he talks about this secret meeting held in Jekyll Island down in Georgia. But the process to form it was really started in the 1890s by J.P. Morgan. And he wanted a central bank, and he realized the American people generally were against this. And so what he did was he took a ton of proxies, and he created this organization that met in Indianapolis, and it was ostensibly independent businessmen. But when you look at who these independent businessmen were, they were all lackeys for J.P. Morgan and the big bank interests. And they met in Indianapolis, and they produced a document about a concern about the monetary system of the United States. And there are quotes in letters of J.P. Morgan basically saying, we don't need them to advocate for a central bank. What we want to do is we want to get the American people to believe that this group of independent businessmen have come together in Indianapolis. They've identified a problem with the monetary system of the United States, and we need to move the monetary system of the United States to be a forefront political issue. Once we get the American people and politicians talking about it, then we'll do our things behind the scenes to make sure that we get the Federal Reserve or the central bank that we want. And so this was a long multi-year period to put a central bank that is much more devious than just a secret island or a secret meeting at Jekyll Island.
Wow.
And so these letters, people can look at it. It's like the Indianapolis Monetary Convention or something by that name that happened in the 1890s, early 1900s. Now, they then meet in Jekyll Island in 1911. These are proxies of powerful banks, political movers, and they take secret train cars down from New York down to Jekyll Island, Georgia, and they were only allowed to refer to each other by their first names so that servants wouldn't know who their last names were. Everything was kind of done in secret, and they come up this plan for the Federal Reserve. Only problem is the president at the time, his name slips me, was not someone who was going to go for it. And so they realized in the upcoming election in 1912 that they needed somebody who was going to play ball. And so they looked for a candidate that they could support, and then they pledged donations to him contingent that he would approve it. And that candidate was the then governor of New Jersey, Woodrow Wilson. And so they approached Woodrow Wilson. They essentially funded his campaign for the 1912 election, and he gets inaugurated in March. And then I think it was December 23rd or 24th or something like that, like the day before Christmas, he signs into law the Federal Reserve Act, right? So that people aren't paying attention, just like they like to do nowadays, on a Friday afternoon or before a big holiday.
Yeah.
And what that did was they also recognized that we can't just have one big central bank. People will realize that what we need is the Federal Reserve System.
Mm-hmm.
So if anybody ever looks at like Jay Powell when he's talking, it doesn't say like Federal Reserve. It's this Federal Reserve System. It's a system. And the key to the system is that the power locus is really at the New York Fed. And so it's a little bit of a, keep your eye on the FOMC or what's going on in Washington, D.C. with people like Jerome Powell. But the Open Market Committee, all of their actions, all of their buying, everything they do, it's all done through the New York Fed. And so, just as a primer for what the Federal Reserve System is there's this overarching governing body in Washington, D.C., but then they set up 12 reserve banks around the country. And initially, these reserve banks had, they were essentially independent entities. So they set their own interest rates. So the New York Fed might have a different Fed funds rate than the Chicago Fed, than the St. Louis Fed, than the Richmond Fed. So there's 12 Federal Reserve banks. And what you have to do is you have to look at who owns these banks. Mm-hmm. So even to this day, you can go on to the website of the St. Louis Fed, and they have an FAQ. And one of the FAQs is who owns the Federal Reserve. And they're kind of like, oh, it's a tricky question. But they admit it in black and white. It's who owns the reserve. The reserve banks are are set up much like private corporations. There are shareholders who receive dividends. And so there is no mistaking that the Federal Reserve is somehow a government entity. They stated on their own website that it's set up like a private corporation. Another telltale sign that the Federal Reserve is not part of the government is the Treasury releases figures of the state of the national debt, and they separate it in two broad groups. One is intergovernmental debt and public debt held by the public. All the Federal Reserve debt is they calculated in debt held by the public with the mutual fund companies and the banks and the insurance. The intergovernmental debt is things like debt held by the Social Security Trust Fund or whatever. So in their own documentation, they consider the Federal Reserve essentially a non-governmental agency. It's on the website. And then in 2017, somebody submitted a FOIA request and said, well, who owns the New York Federal Reserve? We want to know the cap table. We want to know who owns the shares of the New York Federal Reserve. And the Federal Reserve actually released a cap table. And they said, look, we're not a governmental agency. We're under no obligation to respond to this FOIA request. But in the spirit of transparency, we're going to tell you who owns the New York Fed. And it turns out the two biggest shareholders are JP Morgan and Citibank. So this is all publicly admitted who owns it. Now, what's happened over the years is it used to be a money-making enterprise where the banks made money from the central banking. Over the years, they no longer make money from it. When the Fed makes money, they submit profits and income back to the Treasury. But the key is that the Fed is still the banking regulator. And so what they're basically the fox guarding the hen house, and they control banking regulations.
If they send profits back to the Treasury, how are they not just an arm of the government at that point, right?
Well, when we issue our debt, so the Fed owns at one point it was around 9 trillion. Now it's like 7 some trillion on the balance sheet. Mm-hmm. When they get interest from all this debt they hold, they send that interest back to the Treasury. And so a quarter of our debt, essentially, when you hear people quoting 34, 35 trillion in debt, a quarter of it is at the Fed, and we send that money back. Where they are not an arm of the government is in the policies that they carry out on the regulatory side. And so you look at post 2008, 2009, when we had a major crisis, the banks were in bad shape. Up until that point, the Federal Reserve did not pay interest on required reserves. So banks are required to hold reserves at the Federal Reserve that they then use as their base to loan out with fractional reserve banking. There was not interest being paid to the banks. After 08 and 09, all of a sudden we start paying interest. So like right now, the banks deposit money at the Federal Reserve and they're getting 4.5%, or excuse me, 5.5% interest or whatever the Fed funds rate is. I think it's, 5.35, right? The range 5.25, 5.5. So the banks are siphoning off this money from the government and they're making the profit that way. So they're not making it kind of what I would call on the obvious front end of, the U.S. paying interest on its debt, and then the banks get all of that interest. The money goes back to the Treasury, but only if it's held on the Fed balance sheet. And so what people have to realize, and this gets a little wonky and into the woods, is that all of these large commercial banks, they hold mass amounts of money with the Federal Reserve. So the Federal Reserve requires commercial banks to deposit funds with the Federal Reserve. The Federal Reserve pays interest on those monies to the commercial banks. And what I argue is coming is that they are working through these regulation standards to essentially allow the commercial banks to hold more and more government debt, because the Treasury recognizes that all this debt issuance is coming to pay for this massive debt and deficits that we're in. And they're going to have to issue tons and tons of more debt. And what the banks are realizing is this could be a great profit for us, because what we need to do is we need to be able to hold Treasury debt, but we need that Treasury debt not to affect our ability to lend. And so currently there are restrictions on Treasury holdings as far as how much you can lend against it. It affects something that's called the SLR, the supplementary leverage ratio of the banks. In March, the ISDA, the International Swaps and Derivatives Association, which is essentially all the big banks, it's JP Morgan, it's Citibank, they wrote a letter to the Federal Reserve, to the Treasury, and to the FDIC saying, we think that the supplementary leverage ratio on Treasuries should be 0, which would essentially mean that they can buy as many Treasuries as they want and then lend out ad infinitum. And so as the U.S. is going to be issuing more and more Treasuries, and as central banks such as Saudi Arabia and China no longer want these, like they're saying, where are we going to stuff all of these Treasuries? Because nobody wants this junk toilet paper, right? But the banks can buy it. They can get paid on interest and they can stuff it on the balance sheet. The only problem is the more Treasuries they buy, the less they can lend. But if you make the SLR, the leverage ratio 0, then there's no restriction. And so banks essentially have, it's gifting onto commercial banks essentially the power of the Federal Reserve balance sheet to buy an unlimited amount of Treasuries. And this will absorb the Treasury supply without having Treasury rates go to 6, 7, 8, 9%, which would spiral the United States into a Weimar situation where we would, if rates went to 7%, we would be paying out more in interest than we are in getting in tax receipts. And so these central bankers, this is kind of where the modern stuff of how they're planning this whole situation is coming into it, is that they are putting into place all of the deep, like central banking, commercial banking regulation mechanisms so that the Treasury can essentially print unlimited amount of bonds and have those be absorbed by the commercial banks, keeping the interest rates low. But at the end of the day, it is quantitative easing by another name. It is money printing by another name, and it will be inflationary and debasing to the currency. So they're trying to come up with a sneaky way to do it, but they know that they need to do it in a way that's also not going to create the long end of the yield curve to skyrocket to 7-8% on 10 years. And so this is the mechanism they're coming up with. They're putting it into place. Smart market watchers are seeing it happen. And then they're saying, this is inflationary. And that's why you're seeing gold go to 2,400. That's why you saw Bitcoin go to 70 plus thousand. I know it's had a recent pullback. We could talk about Bitcoin and what's going on there. Mm-hmm. But I do think like this is why you're seeing these movements in the markets, but you're not seeing the 10-year spike because people realize they've got a plan to keep that what is called YCC, yield curve control.
Mm-hmm. Wow. This brings up a question then that I wanted to ask you. Basically, what does the central bank then tell the public that they do? Because you hear the dual mandate or whatever of the Federal Reserve. What do they tell the public that they do versus what are they actually doing? Mm-hmm. And are those different?
I think it's been a while since I looked at it. I think they list 5 things that they do on their website. Okay. I think you've got the and it's important to understand that there is more than 2 because everybody will say they got a dual mandate, but there are other mandates that they have. One of them is to create, and this is in the Humphrey Hawkins, like the legislation that authorizes the Fed. Another one of their mandates, and this ties into what we just discussed, is regulating essentially the long-term treasury market and keeping financial stability for U.S. government lending. And so this is a legal mandate of the Fed. And this is why somebody like a Powell, and I don't know the man personally. Why would a Federal Reserve, go along with this? Because in reality, this is part of their mandate. This is what they have been authorized by Congress to do, which is create long-term stability in the United States Treasury market. And so this is how you're going to get into the legal framework is in place for all this to happen legally, and why you're seeing white papers, why you're seeing letters from, the International Swaps and Derivatives Association to the FDIC, because they're not doing this illegally. They're doing it legally. And people are going to see this, and then they're going to recognize it's legal. Eventually, I think the markets are going to see this. And that is going to, once this sort of viewpoint becomes more consensus, I think there's a number of, important market participants who are already coming along to this line of thinking that I'm putting forward. But once it becomes consensus, then you're going to start seeing, people realize that the way that the government is planning to get out of this debt hole is simply through massive issuance and inflation. And that's going to cause a rise in other asset classes, stocks, Bitcoin, gold, silver. What's going to be hurt is the longer end of the yield curve, which is a $130 trillion global bond market, which what's happening right now is it's trying to squeeze into these other asset classes, which are all much smaller. Mm-hmm. The equity asset class, the Bitcoin asset class, which is the smallest, the gold asset class between equities and Bitcoin. And so you're seeing guys like Jeffrey Gundlach who are saying, look, this is real. And Gundlach on one of his podcasts, he talked about like he's actually looking at maybe for his funds wanting to only buy treasury bonds that the coupon is like 1% or less. So in the secondary treasury market, bonds, you can buy a coupon that was issued or a bond that was issued in 2020 with a 1% coupon, and it's discounted to account for that. So then you could buy a 5% coupon. It will be like closer to par, closer to 100 to 100. Okay. The 1% will trade at 70 cents on the dollar. Yep. And he's saying, I might want to, from my funds, buy these bonds, individual bonds that are trading at 70 cents on the dollar because they got 1% coupons, because I'm worried that the Treasury is going to come out and say, okay, we're going to do a restructure of the debt. From now on, the government is only going to pay a maximum of, say, 2% interest. And any Treasury bond that has a yield or a coupon above 2%, we're going to cap it at 2%, and then otherwise we're going to pay it. So they're going to pay par, but it's just this rationalization. Like every month I look at something called the Treasury monthly statement, which is put out on I think it's the 7th business day of every month. So one will be coming up here in a few days.
Yeah.
And it's issued by the United States Treasury, and it lists, all the spending. And I just look at it, and you look at how interest expense is going up. Year over year, interest expense is up like 43%, because it's not that we're just 2 trillion in deficit. It's that we had to roll over in the past 12 months 10 trillion in debt. So we're rolling over this debt that we've been paying 1% on, and now we're paying 4 or 5% on it. And so the increase in interest expense is like exponential. And the typical definition of hyperinflation, of when an economy enters hyperinflation, is when the interest expense becomes greater than the tax receipts. So right now we're at an interest expense of around $1 trillion, tax receipts 4 or 5 trillion. We're not close to that yet. And so I don't think we're headed for a Weimar anytime immediately soon, where people are taking wheelbarrows of cash to buy bread. But I think we're headed towards an intermediary state of prolonged and sustained debasement, and like what could average out over the next, let's call it 5 to 7 years, is an average real inflation rate of like 5 or 6%. And if you compound that over 6 or 7 years, it might not sound like a lot, but it's like a 60% debasement.
Yeah.
So it's like every dollar you have will probably be worth like, 40 cents on the dollar in like less than a 10-year period.
Man. Yeah. I mean, interest payments just passed in the last couple of quarters defense spending, right?
Mm-hmm.
That's like, I'm trying to wrap my head around what that means, because it's like interest payments are the price or something of the dollar, and defense is like the security of the dollar. And it's like they shouldn't cross or something. I can't get my mind around it. What does it signal to you that we pay more in interest than we do in defense right now?
I mean, that's like a preliminary signal. So the two major ones are like when your interest expense passes tax receipts, that's like you're headed for Zimbabwe.
That's a zombie
Turkey,
company as a
hyperinflation.
Government, right?
Yeah, exactly.
I mean,
but one of the other major ones is when it passes defense, and it's generally been looked at historically by some people. A guy, Luke Roman, looks at this. Some other people, like this is like a telltale sign of like empire decline. Once you can go back to the Roman Empire. Like once you see this, like this is like a big red flag that you're paying more to service your debt than you're spending on defense. And that is the situation that we're in, and it's getting worse, and it's not getting worse in a linear fashion because of the way we're restructuring our debt. And I think that's why they're recognizing like we're going to need to do this yield curve control. We're going to need to basically mandate that banks buy this debt, and then what the banking system is going to do is it's going to they want to monopolize the movement of money. So there's a certain amount of cash that gets held in checking accounts or savings accounts because it's excess cash. As the rates on that go low compared to the market rate of interest, that cash gets moved away. So we saw once people realized that my JP Morgan checking account is paying me 0.5%, but the 3-month T-bill is paying 5%, you saw like money market funds and stuff went up to 6 trillion. People basically stripped out of their checking accounts any money that they don't need for transacting.
Yeah.
And that is the same with corporations. And so when you look at what are banks holding in checking accounts, it's primarily a level that is required for the movement of money in the economy. And what the Federal Reserve and these people need to make sure happens is that you still need a bank to move money. And so this is a threat of Bitcoin. This is a threat of stable coins, is you're now able to not only hold value, but you're able to transfer value without it being in a Federal Reserve depository institution. And this was something I did, a couple months ago on another show, was a deep dive into something that came out in April, which was called the Loomis-Gillibrand Stablecoin Payment Act, which was a law by Congress that was going to mandate every stablecoin issuer that any treasuries that they hold on behalf of their stablecoin holders have to be essentially deposited with the Federal Reserve. And so this is maintaining this monetary control mechanism within the banking system. It's starting to fall apart, but I'm not convinced it's completely going to go off the track to like, Weimar type things. I'm thinking that they're actually going to be able to manage this through somehow, but people need to be aware that the byproduct of it is prolonged period of inflation, which probably is, like I mentioned earlier, going to represent like a 60% debasement in buying power in the next 5 to 10 years. So, a house that costs $1 million now might cost, 160 or 1.6 million in a few years. And that these assets are going to go up, but we just don't know how it's going to turn out, because as, things get more and more uncertain, I think there's also the risk for volatility to enter the stock markets, because this is such a fundamental shift in the system. And so what's likely to happen, in my opinion, is at one point where people are right now thinking this management's going to be okay. Therefore, let's buy assets that do well in an inflationary environment. Let's buy stocks. Let's buy NVIDIA. Let's buy Lilly. Let's take the S&P 500 to 7,000-8,000. It reaches a crescendo point, a bubble a la 1929. People then start to realize, oh my God, there's like a currency crisis type collapse scenario waiting in the wings. I better get my money out while I can. That becomes a psychological phenomenon where other people start selling simply because everybody else is selling. And then you get a collapse in the stock market, maybe even a collapse in the home market. Eventually those rebound, but they also cause crescendos in gold, silver, and Bitcoin, the likes of which we haven't seen since the 1980s, where gold went from $35 an ounce in 1971 when Nixon took us off to 850 in like a 10, 12-year period. And that's what's possible,
Yeah. Wow. I want to ask you a couple more things about central banking. So, to what degree do the world's central banks today work together, as far as you know? And are they incentivized to work together or to compete against one another? Or does it change based on what's happening?
Well, that's a great question. And I think it's a little bit nuanced. I think in general, they work together very closely because their ultimate aims tend to be the same. I think there are points of divergence, and we're getting closer to some of those points of divergence. So the main way they work together is through the Bank for International Settlements, which is the central bank for central banks. It's based in Basel, Switzerland. It's such an important organization and hardly ever discussed in the media. Jerome Powell, he sneezes and people write a report about it. He goes every 2 months to meet in secret in Basel with the leaders of the other 62 largest central banks in the world: People's Bank of China, ECB, Portugal, Bank of Canada. They meet every 2 months. It's known that they meet, but they do not release any minutes on the meetings. They don't release the agenda. They don't do press conferences. They don't do any of the transparency that they do with Federal Reserve meetings, where they have a press conference, they have a statement. A few weeks later, they release the minutes. This is completely clandestine. And it's, you can go to like BIS.org and you could search like BIS bi-monthly meetings, and it will come up. They'll explain to you what they are. There are 3 main meetings. There's something called the ECC, the Executive Consultative Committee, the GEM, the Global Economy Meeting, and the AG, the All Governors Meeting. And they have these meetings. They start on Sunday, they end on Monday. And they like a couple of weeks ago, Powell and Lagarde did a press conference with the central bank governor of Brazil in Sintra, Portugal. Well, they did that on like a Monday or Tuesday. Like the 2 days before, they were in Basel at the Bank for International Settlements. No media coverage.
Wow.
And so they meet there, and they put all of these things, together. And this BIS, this Bank for International Settlements, the central bank for central banks, I mean, it has a huge just unbelievable checkered history. It has Nazi connections. I mean, it could be a whole another podcast in its own right to talk about what this BIS does, and they try to stay out of the limelight. So they
Yeah.
don't call it the BIS Accords; they call it the Basel Accords, right?
Mm.
Basel III. But they're meeting at the BIS headquarters in Basel, Switzerland, because they just do not want their name in the limelight, and that's a great sign that something's going on that you should be suspicious about. When they
Yeah.
just call it the Basel Accords or Basel III or Basel II or
Yeah.
Basel III Endgame, it's happening at the BIS, and they have these subsidiary organizations like the um, Stability Institute, and they were the entire euro was planned there. The head of the ECB
Oh
was
man.
in the Basel headquarters building until it was finalized, and then they moved it to Frankfurt, Germany, which is, I mean, that's the Rothschild banking dynasty. That's where the
Wow.
Rothschilds come from. I mean, basically, the BIS helped put into place the entire Third Reich economic plan, which was get rid of national borders, create a common currency, and headquarter it all under a central bank based in Frankfurt, Germany. And like, boom, it got put in place.
Wow.
Um, those are all other stories. Half of the BIS board was indicted for war crimes during World War II. They had guys on there that were in charge of gold confiscation at Jewish concentration camps. I mean, this organization is so shady
Yeah.
and so unbelievable. And then you want to know why do they like to keep their name out of the headlines? It's because, but at the end of the day, all the central bankers go there. They meet every 2 months. They meet in secret. They coordinate global monetary policy, and the marching orders come out from there.
Wow. Do they have so like the Federal Reserve released who the shareholders of the Federal Reserve are, being the
Mm-hmm.
banks, the
Yeah.
commercial banks. Does anyone know who owns the BIS or how that works? Who's controlling it, or
Yes.
who owns the shares in it?
It's owned by the member central banks. So it's owned by the central banks, which are owned by the banks. So it's owned by the commercial banks. Um, and actually, in the United States, when this organization was formed in 1930, there was people in the United States political sphere who said we don't want you know uh, to own this. Like we don't want the Federal Reserve to be the owner of BIS shares, but we want the Federal Reserve to participate. And so they just didn't even bother with, funneling it through the central bank. So the big U.S. banks bought all the shares. So Bank of America, JP, like that's who owns the BIS. So this is all owned by private banks. You can find any of this. I mean, it's like with the Federal Reserve System, the Bank of New York, owned by, as I mentioned, JP Morgan, Citibank, other big
Mm-hmm.
banks. What does that mean? Well, the shareholders get to appoint the boards. So, like, if you look at who appoints the board members of the Federal Reserve Bank of New York, it's the shareholders. So, Jamie Dimon basically gets to appoint who he wants to the board of the New York Fed. Um, and it's specific and it's shady, but it's all there in black and white, and they always try to be nuanced about it. So the banks don't get to appoint all 9 board members. So each of the 12 Federal Reserve banks has 9 board members, but the
Mm-hmm.
banks get to appoint 6. Well, I mean, if you get to appoint 6, I mean, right? I mean, it's like, oh, I get to appoint 280 people to Congress, right? Well, I
Yeah.
don't get to appoint the whole Congress, but I get to
Yeah.
control Congress.
Yeah.
And this is how they control these institutions. And they do it, and it's out there, it's on their websites, they admit it. It takes some crazy guy like me who loves reading all these crazy white papers they put out and digging into it to try to distill it down to these, high level bullet points, because there are intricacies to it, and they try to make it covert and put in jargon, and they try to obfuscate, and they try to do all the Wizard of Oz stuff,
Yeah.
right?
Uh-huh.
And at the end of the day, there is that man behind the curtain, who's pulling those strings and making the smoke puff and blow. But believe me, that's really all that it is.
Wow. Um, You want to talk a little Bitcoin here at the end?
Yeah, sure. Why not? I mean,
All right.
that's one of the biggest things to happen in the monetary world, maybe in centuries, maybe in millennia. Um, the question is, how is it going to turn out? And
Yeah.
I am not sure. Like personally, I own some Bitcoin. I love the idea of Bitcoin.
Hmm.
I think that it is like so smart in its design. It's tied to energy. It's 21 million cap. The halvings, the way those work, uh, everything about Bitcoin. The triple entry accounting. I mean, it's just the smartest thing in the world. It's
Hmm.
like the greatest idea. Um, the concern I have about it is that these powers that be, right? Like
Yeah.
this is a threat to those powers that be. And I know there's a lot of stuff that is in place so that people can have it in cold storage, can have their own wallets, don't hold it in an ETF, don't hold it through Coinbase,
Hmm.
and no one's going to kind of be able to get their hands on it. But if they ever decided to shut off the monetary windows so that if somebody accessed the wallet and tried to access it, they couldn't somehow put it into dollars or whatever, I worry a little bit about that. And what I think is happening right now is um, we are still involved in two things, like a massive price discovery process of what Bitcoin should be worth, and then the ultimate acceptance by the established financial and monetary system of Bitcoin as digital gold, as a store of value. And as it becomes more and more accepted, as it becomes, you know, um, trusted, it's building trust, right? It's building
Hmm.
trust. Like it can handle the crash in 22 and 23. It can handle Sam Bankman-Fried and FT. It can
Yeah.
handle these things. That trust grows. As that adoption rate increases, the price increases, and I think that can continue. And that continuation, when it finally gets to being truly adopted, like the price it needs to be at for that, I think is at least in line with the gold market cap,
Yeah.
which is still 7 or so times um, what the Bitcoin market cap is. And so, just to get to the point where Bitcoin is truly accepted and takes its place as a digital gold, I think you probably need at least a sevenfold increase
Hmm.
to get there. And let's say the old high 70,000, you do a sevenfold increase, you're at basically almost about $500,000.
Yeah.
I think until we get to a $500,000 of Bitcoin, there's still this discovery process, this acceptance process.
Yeah.
Once Bitcoin gets to a 500,000 or on par with gold as far as market cap, I think you'll start seeing Bitcoin trade at like a 90-95% correlation to gold.
Hmm.
Until that happens, you're going to have this price discovery where Bitcoin, in some sense, will have a higher correlation to NVIDIA or the NASDAQ 100 than it does to gold because it's still in this risk category. But I think
Yeah.
as it moves towards adoption and acceptance, it's going to move closer and closer to gold. And so I think this recent downturn in the last few weeks with the Mt. Gox sales and
Yeah.
the German bank sales, like seeing this volatility to me is the best thing that you could see in Bitcoin, because what it signals is we're not yet at that digital gold status yet.
Yeah.
We're still at adoption increasing, trust increasing, and as long as adoption and trust are increasing, and as long as Bitcoin has the potential to drop 30% in a few weeks, that volatility also means that Bitcoin has the potential to go up 200% in 10 months.
Yeah.
And so the potential for seismic gains in Bitcoin, I tweeted out about this, are still there because we're seeing this volatility. Once the volatility drops and it starts trading like gold, then the potential for seismic gains are gone. And so I think
Hmm.
there's a risk there. I think you're being compensated for that risk. But I also think that the byproduct of that risk is volatility, and
Yeah.
that's what we're seeing in Bitcoin. Longer term, I think it's got that potential amazing upside. But I think don't be surprised if you see periods like this where it goes up or down 20% in a couple weeks.
How did you come to find Bitcoin and understand Bitcoin? Because I feel like it's hardest for the people that were in traditional finance at one point to see it. It's easier to explain it to someone who doesn't know anything about money at all. So how did your
Mhm.
story go with relationship with Bitcoin?
Yeah. Well, probably like one of my biggest financial regrets was not buying a bunch of Bitcoin when I first was intrigued by it, which was all the
Yeah.
way back in 2012. So I was driving from my home in Seattle to the offices at Russell Investments in downtown Seattle, and there was an NPR story on, and it was talking about this new thing called Bitcoin.
Oh
I
wow.
don't know what it was trading at the time, 70 cents, $2.
Nothing.
I don't know what it was. And I had been somebody who had always been into like understanding that this monetary, situation is crazy. And I'd been one of these crazy guys in my 20s. I was buying physical gold and physical
Oh
silver
wow.
because I
Okay.
just thought this was ridiculous. And I started hearing about Bitcoin, and I'm like, this is just all making total sense to me immediately. So I didn't need any convincing that the idea was unbelievable.
Okay.
Like a lot of typical finance guys, my skepticism was on the adoption and the technical side.
Hmm.
Like, how do we know this can't be monkeyed with? How do we
Yeah.
know that the larger financial world will begin to accept it? But the premise of it immediately made sense to me, and I started looking into how can I get my hands on
Mm.
it in 2012, and it wasn't easy.
No.
And like I said, the biggest financial regret is I gave up. I was trying to look around. How do I do it? I do this. I got to send money somewhere here. I don't know if and I didn't buy it
Yeah.
at first. And it wasn't until 20, I think 18 or something, where I bought my first Bitcoin.
Hmm.
And so, I've been in it for, a number of years now, and I bought it, sold it, always kept a core position. Thank God.
Hmm.
Made a big mistake and sold some of it as it was falling. I'll be honest with people. I'm not a perfect investor. I'd be worth billions if I was. I fell into it. I saw it get to almost 80. I saw it go down. I got rid of some of it. Another big mistake. But I always was like, there's a core position that I'm never
Yeah.
going to sell
Mm.
because the idea is there. And two things: one, the fundamentals are sound, and two, um, I'm just going to hate myself if I got rid of all my Bitcoin and I saw it go to $1 million one day.
Yeah.
So I've always believed that. So I came to it, a little late. Like a few years went by after I first looked into it, and then it started going up. I think it hit like 10,000 for the first time or something, and then it pulled back. And that was around when I started getting interested in it again and started buying it. And so what I did eventually was I started to get more comfortable with it, read some books about it, understand, how the nodes work. I mean, I'm not a technical expert on it, but like, okay,
Yeah.
here's how you can own it. Here's how you can do it. Here's how the blockchain works. Here's the intellectual underpinnings of it. And I'm by no means a Bitcoin expert, but
Mhm.
I've gotten comfortable enough with the technology. I was, as I mentioned, immediately comfortable with the idea of it,
Yeah.
and then just being validated, as I said, through these processes, through coming back from that huge decline. That will kick the butt of a lot of asset classes to have an 80% decline. You will not see a new high normally for a long time after an 80% decline in an asset class.
Yeah.
And we had a new high, within less than 2 years after that decline. So you start seeing these things and they add to the belief. They add to
Yeah.
the belief like, yes, this has staying power. And the market, then you see the ETF, which I'm skeptical of. I really don't like it. I don't like the fact
Hmm.
that the U.S. government and the NSA hold so many Bitcoin because of confiscations.
Yeah.
I don't like the fact that it's moving into the accepted system as much as it is. But despite all of that, I'm still bullish on it, and I still believe in it. I believe that it has not yet reached that point of being treated as digital gold yet. I think it has that potential. I think by the time it gets there, the easy gains are going to be gone. I think the easiest gains are already gone, but I still think there's huge gains to come. And then once it gets to, like I said, the volatility of gold and it starts correlating 95% to gold, at that point, it's going to be a stable mechanism. The worst thing that could happen to Bitcoin is it go through a 12-month period without a 30% decline, because that's just going to be a signal that it's maxed out. It's been accepted as digital gold. You need to see massive volatility to realize it's still early innings and there's still seismic gains to go. Once you lose that volatility, then you'll know Bitcoin, gold, whatever, but it's going to do the same thing. But I think that's where it's heading. And I think, for people that think, hey, I missed it, like, this is a great time. If you have some cash that you're thinking about, and I think when we came on, it was still in the 50s, who knows what happens with it, but this is a time to say, hey, because, who knows it? I mean, this could be a long-term low. I mean, whatever it was the low in the last week, I mean, Bitcoin may never get to that again, ever. I mean, that could be it. Like, we could be starting a slow climb back to new highs, and then it could go from there. And the days when you can get 53 or whatever it got to as a low or whatever, that could be your last opportunity to get it at that price. This isn't financial advice. I don't give financial advice because without knowing individual circumstances, but just speaking about it as an asset, this could be one of the last great gifts. If you kick yourself for not buying it when it was 22, and you're thinking about it, you don't want to maybe kick yourself in 3 months when it's 100 and say, oh, I could have bought it for 53 or whatever, 56 or 7, whatever it's at.
Yeah. Wow. So what do you think? So the risks, not many people in the world know the power of Bitcoin. So there's still tons of people that have no idea what it is or what it does. So you have to those people have to adopt. So there's one risk. And the other is, like you said, the government, the banks, the central banks, they don't like it. It's a threat to them. So you got these huge risks. If you were to zoom forward, what do you think Bitcoin's ultimate fate will be in 20, 50 years, whatever timeline you want to pick?
Mm-hmm. Yeah, well, that is a crystal ball prediction, and so it has to be taken with a grain of salt. Mm-hmm. But what I think ultimately is that there is still a predilection, a desire to also use gold as a store of value, especially in places like the Middle East, in the East, in China. And I think what can really drive gold over the medium and longer term is its reincorporation as a monetary metal. So in the 70s, when we went off of gold, central banks became sellers of gold, net sellers. There was this constant supply. We're seeing the effects of new supply from large holders, just in these last couple of weeks. And there was a multi-decade period of central banks pushing supply of gold onto the market. Mm-hmm. It still did relatively well. If you go back from 1971 until now, I think if you don't include dividends, which are important, I grant you, gold and S&P 500 have basically done the same thing since 1971, ex-dividend. Now, if you look at Bitcoin, what I see happening is it also beginning this process of being incorporated as a true monetary metal, not just by individuals, but also by central banks. And that a central bank like a Saudi Arabia or a China, and they probably are already doing this already, starts to realize we need to hold some of our reserves, not just in gold, but we need to hold Bitcoin. And so I don't see it as one day the entire monetary system, the entire monetary world actually revolves solely around Bitcoin. What I see is that Bitcoin takes a rightful place as a digital reserve asset, not a currency used for transacting, as a reserve asset that holds its value in a way similar to gold. And that once it does that, it then occupies that space. As assets move from bonds, which are currently being the number one reserve asset on the books of central banks around the world, is U.S. Treasuries. As the U.S. Treasury begins to continue its slide as the dominant reserve asset, and those monies move into, sovereign bonds of China, they move into gold, Maybe some of these central banks say we want to add silver, we
Yep.
want to add Bitcoin maybe they want to own farmland. I don't know. But when they start to realize we need a store of value that isn't the US Treasury,
Yeah.
and Bitcoin is an important element of that diverse portfolio of a store of value of reserve assets, like I said, that's when Bitcoin should probably at least approximate the market cap of gold. As I said, it has certain things that are superior to gold.
Mm-hmm.
It has the hard cap at 21 million. Another big element that makes Bitcoin really attractive as a monetary instrument is that there's no practical use for it. A lot of people say, well, what's the use of gold? Like, you don't want an asset, a reserve asset, to have a practical use. You don't want it to use copper as your monetary metal, because copper goes into so much that people build, it disrupts the economy. You want something that's actually useless other than as a store of value. That's the ideal. That's what Bitcoin provides. And so it could exceed the market cap of gold. So maybe I'm being a little less optimistic or bullish than some people who think there's going to be a monetary system that revolves around Bitcoin. I'm not saying that's impossible. That's not what I see as the most likely scenario. My personal belief is that Bitcoin eventually takes its rightful place as a monetary instrument store of value, aka gold, and that it's held in that type of amount with that type of respect, and it holds its value. And in order to get to that position, it's going to need to be held by financial institutions, by central banks. In order to get there, it's going to need a massive increase in market capitalization from 1 point something, 2 trillion, whatever it's sitting at now.
Yeah. Wow. Mel, this is amazing. You've got quite a command of the history and all your knowledge around this stuff. Thank you so much for taking the time to talk today.
Well, I really appreciate it. I had a great conversation. It's something I'm passionate about, I care about, and I just love to, share the word. If people are interested in these themes, a lot of them are embedded in my book, Quoz. As I mentioned, it's like a financial thriller with corrupt central bankers and the blockchain. Quantum AI is another element of it, and they probably like that. The audiobook is actually just being released tomorrow. It's available for pre-order now on Audible or other different audio sites. The paperback's been out for a few months, and that's available as well wherever books are sold. Amazon, Barnes & Noble. All you got to do is search Quoz, Quoz, financial thriller or whatever, or check out my website, melmattison.com, and there's information and stuff. So really appreciate it. Thanks for having me.
I'll link to the book. I'll link to your website, and I'll link to your Twitter. Anywhere else you want to send people to?
No, that's great. Okay. Twitter, Mel Mattison 1, my website, melmattison.com, and that's perfect in the book. Yeah.
All right. Thanks a lot, Mel.
Thank you, Henry.